Hello, welcome to our webinar, and thank you for taking the time out of your busy day to join us. We're happy to partner again with the Options Clearing Corporation, or OCC, to bring you this webinar today on understanding implied volatility. My name is Gina Bocayes, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few housekeeping matters. The session today will last 1 hour. Our speaker will present for approximately 45 minutes. We'll then open it up to Q&A to answer all your questions. We ask that you look now to locate the Q&A box on your screen. If you have any questions during the presentation, please feel free to type them into the Q&A box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And to tell you briefly about eOption, as our name implies, we're a brokerage firm that specializes in stock and options trading. We offer you some of the lowest rates around, including 0 commission on stocks and exchange traded funds, and options are just 10 cents per contract. And you can trade on our powerful trading platform and mobile app. And our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for nearly 50 years. He created his ideal trading company that caters to those who have a passion for investing. And at eOption, we support trading education, and we usually do 1 to 2 live webinars per month with industry experts. And we hope you'll continue to join us. We also encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. You can go to youtube.com/eoption and take a moment now to subscribe. And if you subscribe, you'll also be notified as soon as when a copy of this recording is available, which should be in the next few days. We also encourage you to visit our website at www.eoption.com, where you'll find all kinds of educational material to learn about trading, as well as our past webinars and videos. I'd like to turn your attention to our speaker now, Ken Keating, who is an associate principal of investor education at the Options Clearing Corporation. Ken has been a trader for 25 years and has worked on the trading floor of the Pacific Coast Stock Exchange and the Chicago Board Options Exchange. He has held positions as a floor market maker, floor specialist, risk manager, and off-floor prop trader. And he's also worked as an options portfolio manager, as well as trading for himself. So without further ado, I'll turn it over to Ken now. Thank you.
Well, thank you for that introduction, Gina, and thank you everyone for joining us here today for another eOption sponsored webinar presentation. Once again, my name is Ken Keating, and I'll be giving today's presentation on understanding implied volatility. I also want to thank Gina and Scott and all the great people at eOption for hosting this webinar and for all the great things that they do for the ever-growing community of options investors with their competitively low rates and their amazing trading platform. So my name is Ken Keating, and before we get started, we always have to mention our disclaimer. Options are rather complex vehicles and do involve risks. So anybody who's looking to trade options should read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org for a digital copy, or you can always reach out to your broker for a physical copy as well. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. Okay, a little bit about the OIC. The OIC, we are the Options Industry Council. We are essentially the education arm of our parent company, OCC, the Options Clearing Corporation. Options Clearing Corporation is the world's largest equity derivatives clearinghouse for exchange-listed options. So essentially, we started out as a cooperative in 1992 to better educate the public on both the risks and the benefits of exchange-traded options. So we can be reached at optionseducation.org for all of our educational materials, which is completely free of charge. Or you can also reach out to us at Investor Education. Our Investor Education desk can be reached at options@theocc.com with any and all of your options related questions. one thing I do have to mention, we are not registered advisors, so we can't give you advice on specific stocks, specific setups where you should be investing your money in the options market, but we can discuss general strategy, options theory, or how a corporate action may impact your options position. All right, well, here's today's presentation outline. So we're going to be talking about volatility or implied volatility. And I always tell people this, that implied volatility is literally the most misunderstood but crucial aspect of trading options. And anybody who's looking to trade options should read and understand. Sorry, my slides are a little whack here. Anybody who wants to trade options but trade them profitably, which I know you all do, because why else would we be trading options? We need to have a firm understanding of implied volatility and how it can impact us. So we're going to be looking at historical volatility. We'll then be looking at implied volatility. We'll be looking at the Greek Vega, which is our option sensitivity to changes in implied volatility. We'll also be looking at historical implied volatility. And lastly, we will be examining certain volatility strategies that we might be able to incorporate that are pure vol strategies, and we can use implied volatility to our advantage. Okay, so what exactly is volatility? Well, volatility essentially is simply fluctuations in an underlying stock price. This can be moves to the upside, it can be moves to the downside, it can be over a certain period of time, it can be days, weeks, months, longer. So simply put, implied volatility or volatility itself does not imply a price trend. So as you can see here, we have two different stocks. We have stock A, which is in orange, and stock B, which is black here. So the stock A here, orange, trades in it's a less volatile stock. It trades in a tighter range. And stock B here has a greater range. It's a little more erratic. It has bigger upswings, bigger downswings. But once again, this is a stock. Think of a historical volatility as kind of like an EKG for your stock. This is just measuring how volatile a stock is, but it doesn't represent any kind of a directional bias whatsoever. So once again, a stock's historical volatility, it's a backward-looking measure that can be observed and quantified. And this is an observable fact, and it has no predictive value whatsoever. So as you can see, the stock has it's up, it's down. Whatever time frame we're looking at, whether it's a short term or long term, earnings dates could be captured within this time frame. If it's long enough, it could be multiple earnings, it could be binary events, it could be news announcements, whatever. Depending on the time frame you're looking at, is going to capture how volatile your stock has been in the past. So here we have three different stocks. We have stock A, stock B, and stock C, and they all trade at different historical volatilities. So stock A in the gray here trades at a 15% historical volatility, and it has a pretty tight range. So a lot of the observations if all three stocks are $100 stock, and stock A here doesn't have much of a range, so most of the occurrences are going to occur right around the mean, right around $100. Stock B has a little greater range. It trades at a 25% historical volatility. And stock C trades at the greatest historical volatility at 35%. So just looking at these three observations, which stock do you think would have the more expensive options? Well, naturally, intuitively, you would think, well, stock C is a little more volatile, so stock C's options should be more expensive. And all things being equal, most likely they would. But let's just say that stock C just reported earnings, and stock A has yet to report. Maybe stock A is reporting earnings tomorrow. it could be very well be that the options for stock A are trading at a higher implied volatility than the options for stock C. So even regardless of what the stock has done in the past, has no indication of how expensive those options are, okay? So it could very well be that stock A here has higher priced options than stock C. So remember that, just because stock C has been volatile in the past does not mean it's going to be volatile in the future. And just because stock A has been not so volatile in the past doesn't mean it couldn't move in the future. Remember, historical volatility is a backward-looking measure that's basically measuring an observable, it's an observable metric that can be quantified. All right, so now let's look at implied volatility. What exactly is implied volatility? Well, essentially, implied volatility is the volatility assumption at which an option is currently priced in the market. And typically, we can determine what an option's implied volatility is using an options model or a pricing calculator. So the inputs that we put into a pricing calculator there's a lot of known events, or known metrics. There's the stock price at any given time. There's the time expiration, interest rates, dividends, et cetera, et cetera. The one thing that's kind of unknown is the implied volatility. So when we talk about implied volatility, at least when traders talk about implied volatility, all they're really talking about is the level of options prices. So now you have TV shows on these news networks that are talking exclusively about options. And you hear terms like vol, or vol is up today, or vol is down. All they're really talking about is the level of options prices. So when traders say that implied volatility is high or vol is high, it implies that the prices for those options are expensive. And when implied volatility is low, it implies that option prices are low and inexpensive. So remember that implied volatility, where historical volatility is backward looking and it's measuring how volatile a stock has been in the past. Implied volatility is trying to measure how volatile that stock will be between now and its expiration. In other words, implied volatility is forward looking, okay? And only options have implied volatility. Stock does not have implied volatility. So when you pull up an option screen, you pull up your favorite stock and you see these bids and offers and flashing colors and whatnot, and you ask yourself, well, who's making these prices? What's this? There's a bid, there's an ask, these prices that I'm seeing, those aren't random, okay? So anytime you're looking at a price, it is the consensus of anybody who's making a market in that particular option at that point in time. Now it could be individual investors such as yourselves. It could be hedge funds, pension funds, banks. It could be market makers like I used to be, making a two-sided market. So, it's professionals and individuals alike. So it could be anybody who's participating in the market. Those prices aren't random at any given time. So let's just say that we're looking at an option and maybe it's a 50, stocks trading 50, and we're looking at a 55 level call. And the market on that call is $1 bid at 120, 200 up. Well, what does that mean? That means there's 200 contracts that are bid for $1, and there's 200 contracts on the offer at 120. So from a trader's perspective, I would say that right in the middle, $1.10, that's fair value. So I'm going to put you into the mind of a market maker, somebody I used to be. I would say, well, if my idea of fair value is 110, I'll buy the option for $1, but at the same time, I'll sell it for $1.20. And on either side, in theory, I make 10 cents. Okay, it doesn't always work out that way, but in theory, that's the idea. That's a trader's theoretical edge. So, when I'm buying and selling contracts throughout the day, I'm building this mountain of theoretical edge, which in theory should come in. It doesn't always work out that way, but that's the idea. So, what if all of a sudden there's a huge order that comes in? Okay, there's only 200 contracts on the offer. and maybe a big order comes in for 5,000 contracts, and they're willing to pay up to $1.50 for that same option. Well, the 200 at 120 are going to get lifted. Maybe some trade at 125, 130, 140, 145, all the way up to 150. Maybe at $1.50, this giant order gets cleaned up and gets filled. Well, what's happened? Maybe the stock is in the exact same spot. Stock's still trading 50, but those calls have gone up in price. The market on those calls now might be 140 bid at 160. Okay, so now fair value went from being 110 up to 150. So if the stock's in the same spot, well, what's changed? Well, what's changed is the market's expectation for those options. So fair value has gone from 110 up to 150. So it's gone up by 40 cents with the stock in the same spot. Well, what's changed? Implied volatility has gone up. So, the market's willing to bid higher prices for that same option because it anticipates a bigger move. And thus, as option prices get more expensive, implied volatility will likewise go up. All right, so an options price, when you look at an options price, is going to be either comprised of intrinsic value plus time premium or 100% time premium. So for in-the-money options, let's just say stock's trading 50, a 45 level call would be in the money by $5. Okay, maybe it's trading for $6. So $5 of that $6 premium is going to be intrinsic value. So it's in the money by $5. It's the right to buy that stock at $45, even though it's trading for $50. So we would say $5 of that $6 premium would be in the money, and $1 would be time premium. So time premium is the extrinsic value of the option. And this is what decays. This is options are a decaying asset, and the closer we get to expiration, they lose time value. So it's the time value of the option that is affected. And time value is made up of time, volatility, interest rates, and dividends. So going back to that one example, the idea of supply and demand, what if all of a sudden this call is trading for $6 and a huge order comes in and now it's trading for $7, stock in the same spot? Well, the implied volatility has gone up. The options price is now trading for $7. $5 of that options value is still intrinsic value with the stock trading 50, the 45 call with the stock trading 50. The extrinsic value has gone up. It's gone from $1 to $2. So when implied volatility expands and goes up, it's affecting the extrinsic value or the time value of that option. Okay, so that's a very important concept, that the intrinsic value isn't impacted when volatility expands or contracts. It's only the extrinsic value. And also know that, with the stock trading 50, the 50 calls and puts don't have any intrinsic value. They're comprised of nothing but extrinsic value or time premium. And as well as the out-of-the-money calls and puts. Those two are also comprised of nothing but extrinsic value. Only the in-the-money contracts have intrinsic value. Okay, so once again, we talked about implied volatility representing it's forward-looking. So it's anticipating how volatile a stock will be in the future. So this black line is the stock's historical volatility, and this orange line is the stock's implied volatility. In other words, how volatile a stock will be, how the market is anticipating how volatile this stock will be between now and its expiration. And only options have implied volatility. So it's really important. I remember when I was standing in the crowd, when I was trading on the floor, and we'd be doing thousands of trades throughout the day, and we would turn to each other and we would talk about positions and trades that we put on. And when we were talking about options, I would never talk to my fellow trading buddies, and we would never say, well, I bought this option for $2 and I sold this August option for $5. No, we would equate everything in terms of implied volatility. We would say something like, I bought a 32 vol, I sold a 40, or I sold this straddle for a 65 vol. Everything was measured in terms of volatility, because by breaking things down in terms of volatility, it's a way that traders that we could equate to whether those options were expensive or cheap based on where they've been historically. So it was just a way that we would talk about options in terms of price to equate whether they were expensive or cheap. Okay, so will an option's implied volatility return to its stock's historical volatility? In other words, if implied volatility is really high and the stock isn't really moving that much, does that mean that at some point I can expect the implied volatility to go down? Well, yes and no. I mean, typically volatility is what's called its mean reverting, meaning that it reverts back to its long-term historical mean, meaning that over time, if volatility is high, it tends to go lower. And when volatility is low, it tends to go higher. But just know that that doesn't always happen. Volatility can stay high or elevated for long periods of time, kind of like what we witnessed during this year when the markets were extremely volatile in the first half of this year, and prices were very high. The option prices stayed very elevated. In fact, they still are quite elevated. They've come down quite a bit, but they're still somewhat elevated. So it's not safe to assume that volatility will, in fact, return to its historical level. In theory, it should over time, but it doesn't always stay that way. So why be concerned about implied volatility? Well, implied volatility is going to directly affect the market value of your options. Remember, it affects the time value or extrinsic value of your options. So, implied volatility is constantly changing throughout the day, and it's changing due to the supply and the demand for options. So as options get bid up and there's more demand for options, prices will go up. And when there's more supply for options, more sellers than buyers, option prices or implied volatility will go lower. So if you're looking at an options position, maybe you've got a bunch of options on, you've got this position, and the stock's not moving, and you can't figure out why you're making or losing money. Well, if you can't figure out why you're making or losing money on an options position, more likely than not, the reason lies in changes in implied volatility. Either implied volatility has gone up quite a bit or it's gone down quite a bit. So that's why it's also really important to have a firm grasp of implied volatility and how it can impact you. Okay, so implied volatility's effect on options prices. So all other factors remaining constant. As implied volatility goes up, both call and put prices will increase. And this is because calls and puts that share the same strike price have a direct relationship to themselves. Okay, the calls and puts that share the same strike in the same month, the calls should have about the same amount of time premium as the puts, and vice versa for put call parity to hold. So, as implied volatility goes up, it's going to affect both call and put prices. And as implied volatility decreases, it's going to decrease both call and put prices. Now, we'll be talking about Vega in a little bit, but implied volatility changes will affect, obviously the options with greater amounts of time premium. And which options have greater amounts of time premium? The longer dated options. So for longer dated options, for those of you who like to trade leaps or maybe use leaps as a stock substitute, you're buying or selling more time. Well, because of that, you're buying or selling more extrinsic value, and that's changes in implied volatility are going to affect those options to a greater degree than the near-term options. But we'll talk about that more in a bit. All right, so how do we use this information to our advantage? So, I pulled up two implied volatility charts. So this is a chart, and you can actually access this from our website. If you go to optionseducation.org, we have a whole suite of tools, and this is provided to us. This is not something we provide, that we came up with, but we contract with the third-party provider, iVolatility, and this is a free one-year implied and historical volatility chart. So what you're looking at is you have stock A here and stock B. So stock A trades at a lower volatility. So you can see the 52-week implied volatility range for the options is roughly 17 up to 35. So this blue line here is the stock's historical volatility, in other words, how volatile it's been over the past year. The gold line here is the stock's implied volatility, in other words, how expensive the options have been over the last year. So when I was trading on a floor, this is one of the things we would do all day. We would look at implied volatility charts for all the stocks we were trading. And essentially, I would come up with a buy-sell range. So if I'm coming up with a buy-sell range off of this one chart, and granted, this is only a one-year chart. You can look at 2-year charts, 5-year charts, shorter dated charts. All we have on our website is a free 1-year chart, but there's plenty of providers that provide more granular information. But if I were going to use this chart, I would say I would have come up with a buy-sell range. I would say, well, in stock A, I would be a buyer of options when it got in the low teens because it seems fairly cheap. And then historically, when it gets in the high mid 30s, they're rather expensive. Okay. So that would be sort of my buy sell range. Okay. Now look at stock B. Stock B trades at a higher volatility. Its buy sell range, or the low and high, is 31 on the low side up to 70 on the high side. So you can see that stock B, the low range for stock B is at the upper end of stock A. So all stocks trade at different implied volatilities based on how volatile they are. And I can't tell you what stocks these are, but I can tell you that stock A here was a utility stock. It doesn't really move around that much. Stock B here is a chip company, okay, and it trades very volatile. I think it has a beta of 1.5. It moves, 1.5 times that of the overall market. So it trades at a higher level. But, my buy sell range on this stock is going to be different than my buy sell range on this particular stock. So, once again, one thing you want to determine is, and this is very important, you want to kind of figure out where implied volatility is. So let's say I'm looking at stock B here. Okay, so this is its historical range, but right now the options are trading at up to around just below 60. Okay, so that's on the upper end. So if I'm bullish or bearish or neutral, whatever, I would figure out where volatility is. I know right now it's kind of on the upper end. It's a little expensive. Now, knowing that the options are expensive, I can frame that around a strategy. I can say, okay, I'm bullish, but these options are expensive. What strategies are available to me? Because not all strategies work under all circumstances. Some strategies work better in low vol environments. Some strategies work better in high vol environments. So once again, in this case, if I were bullish, maybe I would sell pull credit put spreads, something like that. If I were going to buy calls, and if I'm really bullish, maybe I do a spread where I'm buying a call that's expensive, but I'm going to sell another call against it that's equally as expensive, to kind of offset my cost. So, just know that you want to understand where the market is in terms of implied volatility, figure out what your forecast is, and what whether you're bullish, bearish, or neutral, and then devise what strategy you want to incorporate. Okay, so let's look at an example. Excuse me. Let's assume we're looking at a stock. It's currently trading for 80, and the options are trading at a 30% implied volatility. Now, one thing you need to keep in mind that anytime you look at a volatility number, that's an annualized number, okay? So it represents how volatile that stock will be on an annual basis. So if it's a 30 volatility and the stock's 80, what that's saying is over the next year, this stock should trade, what's 30% of 80? It's 24. This stock should trade between 56 and 104, 68% of the time, because a one standard deviation move is a 68% probability. Okay, so we take that 24, we add it to 80, we get to 104. We take the 24, we subtract it from 80, we get to 56. So a one standard deviation move implies that the stock should trade between 56 and 104, 68% of the time. Well, naturally, if it's got a 68% chance of trading within that range, then there is a 32% chance of it trading outside that range. Because remember, these probabilities have to add up to 100. Now, if we want to look at a 2 standard deviation move or a 2 sigma move, as traders say, we just double that amount. 24 goes to 48, and we take 48 from 80, that gets us to 32. We add 48 to 80, that gets us to 128. So what that means is over the next year at a 30% vol, this stock should be trading between 32 and 128, 95% of the time. And of course, if it's got a 95% probability of trading within that range, there's a 5% probability that it can trade above 128 or below 32. And then you can do the same exercise with a 3 standard deviation move. That would be 72. Okay, 3 times 24 is 72. So 99% of the time, the stock should trade between $8 and 152. 1% of the time, it would trade outside that range. Now, that's all good, but you know, a lot of us don't trade options that expire in a year. So how do we count for that? Okay, so this is the formula, and this is a really good formula that you should probably write down. You can probably download a copy of the PowerPoint presentation and have for your records. But remember that implied volatility it's based on an annualized number. So in order to take that annualized number and to calculate a standard deviation for periods of less than 1 year, this is the formula that you use. So you take your annualized volatility as a percentage, and you divide it by the time period squared. Okay, so remember, volatility implied volatility is a measurement of the square root of time. Okay, so and you multiply it by the stock price. So in this case, if we want to know what the daily expected move is on this particular stock that's trading at a 30 vol, we know the stock's trading 80. It's trading a 30% implied volatility, so we go 0.30. Okay, this volatility is a percentage, 0.30, divided by the number of trading days in a year. There's roughly 252 trading days in a year. And when you square 252, that gets you to roughly 16. Okay, it's not exactly 16, it's like 1587, but it's close enough to 16. That's why they call this the rule of 16. So when you take 0.30 divided by 16 times 80, you get plus or minus 150. So on any given day, we would expect that this $80 stock at a 30% volatility will trade between 81.5 and 78.5, 68% of the time. And you can do this with any stock, any index, any ETF that trades options. If you know the implied volatility of the options, you can divide by the square root of time, in this case 252 for the daily move, to figure out what the daily expected move is on that option. So also keep in mind that you want to, when you're measuring implied volatility, you want to take the overall volatility. Like stocks, options will trade at different implied volatilities depending on what strikes. So generally traders will look at the at-the-money options. The stock's trading 50, you'll look at the 50 call and put, the implied volatility for those options to kind of figure out what the market's expecting, and use that number for your implied volatility number. So you wouldn't take a downside put and use this formula. You'd really or an out of the money call. You really probably want to look at the at the money implied volatility. So you can also do this for other periods. If you want to calculate different periods, you take the same formula and you apply it to different periods. So we already did the exercise for the single day. There's 252 trading days in a year. So the square root of 252 is 16. If you want to know how volatile that stock will be over the next quarter, you divide by the square root of 4, which we know is 2. If you want to look at a monthly expected move, divide by the square root of 12. And if you want to look at a weekly move, there's 52 weeks in a year, you divide by the square root of 52. So once again, a really good formula to know. For many of you, you probably look at there's an index called the Vix, or people call it the fear gauge, and it's the implied volatility of the options on the S&P 500. And right now, the Vix is currently trading around, last I looked, I think it was 24.23. So that's a measure of the implied volatility of the options on the S&P 500 index. So when you do this rule of 16, that calculates out to about a 1.5% daily expected move. Okay. Now, the implied volatility for the VIX is down considerably. It's down 34% because just at the beginning of May, when the market was a lot more volatile, the VIX was moving at it was implying the VIX was about 36.5. It peaked at about 36.5. So that's over a 2% move on a daily basis. So implied volatility, while it's still elevated, has come down considerably. Same thing for the VXN. The VXN is the implied volatility for the Nasdaq options. And right now, when I last looked, it was implying the VXN was roughly about 30.88. That implies nearly a 1.9% daily expected move. So the market's still anticipating big moves. It's not as big as they were, back in early May. All right, so now let's look at the Vega, the Greek Vega. What exactly is Vega? Well, Vega is your options sensitivity to changes in implied volatility. So in other words, how much my options price is going to change with a 1.1% change in implied volatility. And it's always expressed in the decimal form, and it represents a cash amount per option. So if I'm looking at an option, let's just say I'm looking at a call and it's $3 and my Vega is 0.08. Well, and the volatility is trading for 30. Well, what that means is if volatility goes up to 31, all things being equal, and the stock doesn't move, my option should gain about 8 cents, should be trading about $3.08. If implied volatility goes down to 29 from 30, I should lose about 8 cents, and my option should now theoretically be worth about $2.92. So it represents how much your options value in theory should change with each 1% change in implied volatility. And remember, implied volatility is greatest. It's going to affect the at-the-money and long-term options more so because those options are comprised of more time premium. So remember that the implied volatility is really affecting the extrinsic value or time premium of that option, all other factors being constant. So when calls and puts both have positive Vega amounts. So as implied volatility goes up, the option should go up by the amount of the Vega, and when implied volatility goes down, the option should go down by the amount of the Vega. So, but this is where volatility is very important. So oftentimes implied volatility doesn't change in 1 point increments. Earlier this year when the market was making big moves, implied volatility can go up by 10%, 20%, 50%. I remember looking at, years ago, many people were trading these meme stocks, and I remember looking at one of these meme stocks, and the implied volatility was like 850%. It was off the charts. It was crazy, and it was moving in giant chunks. So, once again, it gets to that point of if you can't figure out why you're making or losing money on a particular options position, it's probably because implied volatility is either going up by a lot or down by a lot. Okay, so now let's look at an example. So let's look at Vega in action. So let's just say we have a stock. Stock's trading for 100. We got 13 days to go to expiration, and the stock is trading at a 60 vol. And it's yet to report earnings, so we know this implied volatility is probably a little high because the options tend to get more expensive when, before earnings events. So we look at our options chain and we see that, we're bullish on the stock. We see the 205 call is trading for 255. Has a delta 35, a gamma 3, a theta of 16, a Vega of 7 cents. So we decide, we're bullish and we think the stock's going to make a big move, so we decide to buy this call. So then a week later, the earnings comes out and the stock goes up by $5. So we got the direction right, but look at the value of this call. It's trading for 95 cents less than when we bought it. So you ask yourself, well, what happened? Why the stock went up? How did I lose money? Well, you lost money because, one, you had 7 days of time decay. Okay, the time decay, it's a week later, So you've had time decay working against you, plus the implied volatility has gone from 60 down to 30. So it's gone down 50%. And even though stock went up by $5, these calls lost value due to time decay and decreasing implied volatility. So, in this case, you needed a bigger move on the stock to make money for this very expensive call that was trading for 255. Now, let's just say the stock rallied up to 110. Okay, it opened at 110. Well, this 105 call would be trading for, it would have $5 of intrinsic value and maybe, let's call it 50 cents a time premium. So in that case, you would make money on this option, but you needed a bigger move than you needed a bigger move, probably a bigger move than 7.5% for you to make money on this option. Okay, so once again, this happens to investors. We get calls from investors all the time, and they don't understand what happened. You get the direction right, but volatility, the vol crush that came in after the earnings worked against you. Because remember that before the earnings came out, the earnings were an unknown event, and the market was trying to anticipate how volatile that stock will be between now and earnings. So it priced these options very expensively. So when the earnings came out, what was once unknown is now known, and all that volatility comes out of the options. And that's why even with the stock up $5, they're trading lower. All right, so once again, tracking implied volatility over time, you can look at the historical implied volatility over time, like we did on that one chart, to get an idea of where that stock has been, where it's been, its historical range, the low range and the high range, and figure out where implied volatility is now to come up with what investment, how you want to incorporate those options into your bullish, bearish, or neutral trading forecast. So if the current implied volatility is higher or lower than the historic levels, also know that will it revert back to the mean? Well, yes, over time, volatility is somewhat mean reverting, but that doesn't mean that the market can't stay, high for long periods of time. And it also means that it can't stay, if the volatility is low, that the market might stay low for periods of time. So, there's an old saying in the market that, that the market can stay irrational longer than it can stay liquid. So sometimes when volatility is high, it stays elevated for periods of time. So just something to keep in mind. All right, so implied volatility analytics. Many firms these days have what are known as these analytics. There are two analytics, and they're called IV Rank and IV Percentile. So we're going to look at a couple of these right now. So we're going to say that IV Rank is just another way of measuring how cheap or expensive your options are based on where they've been historically. So IV Rank essentially takes the current implied volatility over a defined time frame, okay, like let's say over a year. And it takes three observations. It's going to take the low point, the high point, and where it is now. So let's just say over the last year, implied volatility has been low of 20%, a high of 60%, and right now it's currently trading at 40%. That would yield an IV rank of 50% because it's trading right in the middle between 20 and 60 at the 50th percentile. So we would indicate that that's neither really expensive nor is it really cheap. It's kind of like in that middle no man's land, okay? And if the IV rank were 0, it would imply that the volatility right now is either 20% or lower, and 100% IV rank would mean it's 60% or higher. So it's basically just taking these 3 points, the high, the low, the high, and where volatility is now as a percentile. Now, IV percentile, on the other hand, this is another analytic that many brokers offer. This is the percentage of days that IV has been lower than the current IV. So it takes this analytic and it's a little more granular. So instead of taking 3 observable price points or points in time, it takes all the points over a given period. So if we're looking over a yearly period and we see an IV percentile of 60%, basically all that indicates is that previous levels of implied volatility have been below the current level 60% of the time. In other words, that implied volatility is rather high. So, it's just another way that you can, another tool that you can use that gives you an idea of how inexpensive or expensive the options are at any given time for the stock that you're looking at. All right, so all that being said, how can we use this to our advantage? Now, there's plenty of different volatility strategies. I certainly can't get into every one of them, but I'm going to talk about two pure vol strategies. One is the long straddle. So a long straddle is a pure vol strategy because this is a strategy where we don't really know. We think the stock is going to move, but we don't know which direction, and we don't really care which direction. We just want it to move. So let's just say a stock is trading for 87.5, and we look at our options chain and we see that we can buy the 87.5 call for 215 and buy the 87.5 put for 185, and we can buy this straddle for $4. So in other words, we don't care whether the stock goes up in a big way or down in a big way. We just need it to move in a big way. So between now and expiration, our break-even points are going to be that $4 that we paid, added to 87.5, that gets us to 91.5, subtract it from 87.5, where the stock currently is, that gets you to 83.5. So we need the stock to move outside, below 83.5 by expiration or above 91.5 by expiration. So if it's above here, we're gonna make money. If it's below 83.5, we're gonna make money as well. Now, if it's anywhere in between come expiration, we're gonna lose money. And where are we gonna lose the most amount of money? Well, if the stock pins right at 87.5 come expiration, this $4 is just going to evaporate. The time premium goes to zero, and our straddle is going to be worth nothing. So that's where we lose the most amount of money, with the stock right at 87.5 at expiration. Now, what if we buy this straddle for $4 and the next day it's trading for $4.50 and the stock's in the same spot? Well, now you know that implied volatility has gone up. You could sell that straddle for $4.50, take your profit, and have no position. And what's happened is implied volatility has gone up, and you can benefit by having that. You benefited from the fact that implied volatility went up. Now, on the flip side, you could say, well, what if I think these options are expensive? Well, if that's the case, you could sell this straddle. You could sell the 87.5 call and sell the 87.5 put, and you would take in $4. The $4 in premium would be a credit to you. But just know, anytime you sell naked options, you have considerable amounts of risk. So if we're short the straddle, this little blue triangle would be inverted. It would actually, I can't draw it here, but it would be like this. So you would need the stock to trade between 83.5 and 91.5. But with selling naked options, you have considerable amounts of risk. If the stock went up, in theory, stocks can go, there's no limit to how high stocks can go on the upside, and certainly stocks can go to zero on the downside. So anytime you sell naked options, you have a considerable amount of risk. So there are strategies that you can incorporate that allows you to sell options while limiting your risk. And we can't get into those right now, but we have plenty of material on our website that gets into those strategies that would involve. These would be credit spreads, selling full put spreads, bear call credit spreads, doing butterflies, iron butterflies, condors, iron condors. These are all strategies that you can incorporate that allows you to sell high implied volatility while limiting your risk at the same time. All right, so the cousin to the long straddle is the long strangle. So now this is also another pure vol strategy where, once again, stock's trading 87. Maybe we don't want to buy the at-the-money call and put. We don't want to pay $4, but we still think the stock is going to make a huge move. It's a binary event. It's going to make a huge move, either the upside or the downside. So we see that we can buy the 90 call for $1.20. We can buy the 85 put for $1.30. That's a total debit of $2.50. Now we need the stock to trade below 82.5 or lower come expiration, or above 92.5 or higher come expiration. So we need a bigger move to the upside or downside, but we paid less for this position. So once again, anybody who's looking to trade a strangle, at least from the long side, you're not going to pay as much, but you need a bigger expected move from the security to profit on. So if it's a binary event, you really think the stock is going to make a 20 or 30% move, you might consider a long strangle. Okay. Also on the flip side, you can sell that strangle, but once again, when you sell a strangle, you're limited. Your profit's always only going to be limited to the amount of credit that you took in this case, 250, and you open yourself up to a considerable amount of risk to both the upside and the downside. But once again, there are strategies that you can incorporate that allow you to sell high implied volatility while limiting your risk. All right, so that is the end of our presentation, and I want to thank you for joining us here today. Let me see if we have a little time left over, so I'm going to open up the Q&A box and see if we can answer some of these questions live. So let's see. Is the VIX, one of the questions that came up, is the VIX calculated from options volatility? Well, the answer is yes. So once again, the VIX is a measure of the implied volatility on the S&P 500 options. So essentially what they do is they take the 30-day implied volatility. It's a blended volatility of the at the money and the out of the money options, and they come up with a figure. So that VIX number that you see, you can't really buy or sell the VIX. You can buy or sell VIX options, but you can't actually buy or sell the VIX itself. That's just an indicator of how volatile or how expensive or inexpensive the S&P 500 options really are. So yes, the VIX is calculated from options volatility. It's the options volatility on the S&P or the SPX, the big SPX options. See, how does implied volatility help in identifying what type of option strategy you want to use? Well, once again, using those volatility charts that it's really good to look at a volatility chart to get an indication of how expensive or inexpensive an option really is. So personally, when I was trading, I would look at 2-year charts, sometimes 5-year charts, 1-year charts. 2-year charts are good charts because it gives you a 2-year time frame. You obviously get 8 sets of earnings within that time frame, so you get a really good feel of where that volatility has been for a particular stock. So I wasn't married to 2-year charts, but I really liked looking at 2-year charts. So some service providers will have a lot more granular information where you can look at 5-year charts, 2-year charts, 1-year charts, monthly charts. There's the level of granularity that you can get down to. It really depends on the provider, but yes, it's good to look at all kinds of different time frames. But essentially, you want to figure out where implied volatility is right now, whether it's expensive or cheap based on where it's been historically, and then devise a trading strategy. So if implied volatility is low, you might want to err on long option strategies where you're either long calls or puts, long debit spreads, long a lower strike call, short a higher strike call against it, long an in the money or at the money put if you're bearish and selling a lower strike call against it. Long premium strategies. If implied volatility is expensive, once again, you can use those strategies that incorporate selling high implied volatility while limiting your risk. Things like credit spreads, butterflies, condors, iron butterflies, something like that. Let's see. Where can you look at IV rank and percentile? Well, that's really dependent on your broker. So many brokers do offer IV rank and IV percentile, so you're really going to want to talk to your broker regarding that. Some platforms have it, some don't. But so I don't really have a source, and even if I did have a source, we were not allowed to give recommendations on third-party providers. I know that the Options Price Reporting Authority's website, Opera Plan, their website is OPRA, Opera Plan, P-L-A-N, operaplan.com. They have a list of third-party providers on their website and all the services they offer. So there's certainly many providers on that site that do offer analytics as well. Let's see, what else? The put should be more expensive than the at the money, than the call at the at the money. Is this not true? Well, typically puts in general are more expensive than calls. So like in theory, if a stock's trading 50, the 50 call and the 50 put should kind of be priced similarly. Maybe the put's slightly more expensive. Certainly the out of the money puts, if the stock's trading 100, the 90 level puts are going to trade at a higher level than the 110 calls. Both options are 10% out of the money. And but generally, because of what's known as skew, the puts will trade at a higher price than the calls. And skew is something that really got incorporated into the market after the crash of '87. So before the crash of '87, the out of the money calls and puts kind of traded at the same level. And then when the crash happened and the market went down, 20+%, it really woke up traders to the idea that stocks go down quicker and faster than they go up. So, there's an old saying that the stocks, they go up on a staircase and they go down in an elevator, which is kind of what we've experienced this year. We had this, 18, 19-year bull market where the stocks, they just grind higher. And then, in a few months, they're down big. They just go down quicker. And because of that, there's this natural skewness priced in the options where the downsides, in most cases, is going to be more expensive than the corresponding upside. So there's a volatility skew to the options. Now, it's not always the case. Sometimes the skews are backwards where, some commodities trade at a reverse skew where the out of the money calls are more expensive than the downside puts. Certainly in the internet bubble in the mid 90s, when there was such demand for upside calls and it looked like these internet stocks were going to go to the moon and they were never going to go down. There was a reverse skew in that instance. So there are periods where there is a reverse skew, but in most markets and most stocks, there's a normal skew where the downside is typically a little more expensive than the upside. All right, so let's look at what else. On the straddle slide, you showed that the at-the-money call is more expensive than the at-the-money put. Yeah, well, that was actually, this slide was taken from an old deck that we had, and yes, you're right. That typically those prices should probably be trading roughly at the same price rather than the call trading higher. So that's a little error. We'll have to fix that on the slide. But thank you for noticing. Can you please talk about a strategy that takes advantage of volatility crash after the earnings announcement? Okay, well, if volatility typically declines after an earnings event because what was once unknown is now known. So if that's the case and volatility crashes, those options obviously are going to get a lot more inexpensive. So if you're bullish, you think that the volatility's gotten crushed, but the stock's got more upside, then you might consider just buying calls outright, or you might put on a call spread. If the earnings come out and the volatility gets crushed, but you think the stock's going to walk down, maybe you might consider buying a put or doing a put spread, being long a debit put spread. So, it really all depends on what your outlook is on the stock, but that when the volatility comes in and gets crushed, those options are going to be a lot cheaper. So you want to employ strategies that typically focus on long options rather than short options. So, once again, getting back to that idea that figure out where implied volatility is right now at this point in time, figure out whether it's cheap or expensive, and then figure out what strategy you want to deploy based on your forecast and motivation. And I think that's about it. So once again, if you ever have any more questions, you can always reach out to us at options@theocc.com with any and all of your options related questions. If you have a question regarding this deck or any other question you have about options, remember that we can't give you advice, but we can talk to you about anything that has to do with strategy or theory or corporate actions. And once again, that's a free service, so you can always reach out to us with any of your questions. So with that, I'm going to hand it back to Gina, but I want to thank everyone for joining us here today. I hope you got something out of this presentation, and hopefully I look forward to talking again with you in the future. So have a great day, everyone.
Great. Thank you so much, Ken. That was very interesting and informative. And thank you to all of our attendees for taking the time out of your busy day to join us and for your excellent questions. And we did get a question. Someone asked for the slide deck. And so we're happy to send that to you. Just send us an email at support@eoption.com and we can get that right over to anyone who's interested. And if you also have questions that weren't answered at this webinar, or you have a few additional questions, we're always happy to talk to you. So again, just shoot us an email at support@eoption.com and we'll answer any questions that you have. And just looking at this last screen, just wanted to highlight a few special promotions and items about eOption. The first one is we charge some of the lowest commission rates around. So it's 0 for unlimited stock and ETF trades, and options are just 10 cents per contract. So if you're interested in opening an account, we hope you'll check us out at eoption.com. And we are offering a special promotion when this goes live on our YouTube channel, which should be tomorrow, and you subscribe, you'll see at the bottom, just under the video, we'll have a special promotion where if you open an account, we'll give you free stock. So make sure you check that out. And that's only for a limited time. So I urge you to check that out in the next few days if you can. And I just wanted to also let you know about our next webinar. It's interactive options trading session with a professional trader. And that's in a few weeks on June 29th at 1 p.m. Central Time. And you can register at www.eoption.com/webinars. And this is a little different format where we have a professional trader who's been trading for over 30 years. And he's going to answer all your questions and walk you through live scenarios and option strategies you can start using right away. So we hope that you'll be on the lookout for that email or register on our website today. And just to quickly sum it up, again, we urge you to go to eoption.com. Ken mentioned a few volatility strategies, such as a long straddle and a long strangle. If you'd like to learn more about those, we have these wonderful clickable strategy links, and you can just click on it and it'll tell you when you use those strategies, as well as videos explaining more. So eoption.com can be a tremendous resource for you. And last, we just urge you to subscribe to our YouTube channel so you don't miss any of our trading videos. So thank you for your time. We really appreciate it. And we hope to see you at our next webinar on June 29th. Thank you and have a wonderful day. Bye now.